Imagine a world where your money works for you, effortlessly generating a steady stream of income. Dividend stocks have the potential to transform this vision into reality, allowing you to harness the power of passive income. But how do you navigate the vast ocean of stocks and select the right dividend stocks to ensure long-term financial success? In this comprehensive guide, we'll dive deep into the art of picking the right dividend stocks. From understanding the basics to conducting thorough analysis, this video will equip you with the knowledge and tools to make informed investment decisions. Get ready to embark on an exciting journey towards financial independence. Section 1. Understanding dividend stocks. To effectively choose the right dividend stocks, it's crucial to understand the fundamentals. Dividend stocks are shares of companies that distribute a portion of their earnings to shareholders as regular dividend payments. These payments provide a steady income stream, making dividend stocks an attractive option for income-oriented investors. Let's think of dividend stocks as a slice of a delicious pie. Just like you receive a portion of the pie when it's divided among your friends, owning dividend stocks means you get a portion of the company's profits. The company shares its success with you in the form of regular dividend payments. But what sets dividend stocks apart from other investment options? The answer lies in their ability to generate consistent returns, regardless of market conditions. Even during challenging times, while the pie may shrink, dividend stocks continue to pay out dividends, offering stability and a reliable income stream. When considering dividend stocks, one important metric to evaluate is the dividend yield. Think of the dividend yield as the icing on the pie. It represents the annual dividend payment as a percentage of the stock's price. A higher yield may indicate a higher income potential. For example, if a stock is priced at $100 and has a dividend yield of 5%, it means you can expect to receive $5 in dividends for every $100 invested in the stock. Additionally, analyzing a company's track record of dividend payments, known as dividend history, helps assess its stability and commitment to returning value to shareholders. Imagine you have a friend who always keeps their promises. They consistently pay you back when they owe you money. Similarly, look for companies that have consistently increased or maintained their dividend payments over time. This demonstrates their dedication to rewarding shareholders. As you embark on the path of building a solid dividend stock portfolio, envision a future filled with the opulence of luxury cars and the joy of relieving your parents of their financial burdens. Just like a skilled artist, you have the power to paint a masterpiece of financial success by wisely choosing dividend stocks. Embrace this journey with passion and curiosity, navigating through the seas of financial markets. As you progress, let the colors of optimism and determination guide you, ensuring that each investment stroke contributes to your dreams. Remember, you're not alone. Seek advice from experienced mentors and share your success with others. Happy investing, and may your canvas of prosperity be adorned with the rewards of financial freedom. Section 2. Evaluating dividend health. Examining a company's financial health is vital when selecting dividend stocks. By understanding the company's ability to sustain and grow its dividend payments, you can make informed investment decisions. One key factor to consider is the dividend payout ratio. Let's compare it to your personal finances. Imagine you earn $1,000 per month, and your monthly expenses are $500. If you decide to spend $400 on entertainment, your payout ratio would be 40%. In the same way, a sustainable dividend payout ratio falls within 40 to 60%, allowing the company to reinvest in growth while still rewarding shareholders. A high payout ratio may suggest that the company is distributing a significant portion of its earnings, which could impact its future growth prospects. Furthermore, analyzing a company's cash flow statement is crucial. Think of it as tracking your own cash flow. By reviewing the company's cash flow statement, you can ensure it generates sufficient cash to cover dividends and maintain financial stability. Just like you need to have enough cash to pay your bills and enjoy some leisure activities, a company needs to generate strong and consistent cash flow to sustain dividend payments. Another aspect to consider is the company's dividend history during economic downturns. For example, during a challenging time, such as a pandemic, some companies may reduce or suspend their dividend payments. However, others might maintain or even increase their dividends. A company with a resilient dividend track record during recessions demonstrates its financial strength and commitment to shareholders. Section 3. Assessing company stability and growth potential. Stability and growth potential play a crucial role in dividend stock selection. Investing in companies with a solid foundation and promising growth prospects can lead to long-term success. When evaluating company stability, examining financial statements is paramount. Think of it as inspecting the building blocks of a house. Look for consistent revenue growth and earnings growth over time. Companies with a track record of stable growth indicate their ability to weather market fluctuations and sustain dividend payments. Just like a house with a strong foundation can withstand storms, companies with consistent growth foundations can navigate market challenges. Additionally, consider the company's debt levels. Excessive debt can be a burden, just like carrying a heavy backpack while hiking. It may limit a company's ability to allocate funds toward dividends and future growth. Seek companies with manageable debt loads, as this demonstrates prudent financial management. Furthermore, industry analysis is essential to assess a company's position within its industry and the overall market. Let's imagine you're a sports fan and you're comparing two teams. One team plays in a highly competitive league where they have to constantly up their game to stay on top. The other team competes in a less competitive league, enjoying more advantages. Similarly, look for companies operating in stable or growing industries with a competitive advantage. This advantage could be a unique product or service, a strong brand, or a dominant market position. Investing in companies with a sustainable competitive advantage increases the likelihood of consistent dividends and potential capital appreciation. Section 4. Dividend Sustainability and Growth. Choosing dividend stocks that offer both sustainability and growth potential can enhance long-term returns. By evaluating a company's ability to cover its dividend payments and its history of dividend growth, you can identify stocks with strong prospects. Dividend coverage refers to the extent to which a company's earnings can comfortably cover its dividend payments. Imagine you have a monthly income of $2,000, and your monthly expenses, including rent, bills, and groceries, add up to $1,500. Your dividend coverage ratio would be 75%. The higher the coverage ratio, the more secure the dividend payment. Analyze the company's earnings and compare them to its dividend payments to assess its dividend coverage. In addition to dividend coverage, consider companies that consistently increase their dividend payments over time. Let's think of it as a garden that grows steadily. These companies demonstrate confidence in their future prospects and have a track record of rewarding shareholders. Look for a history of annual dividend increases or a pattern of maintaining dividends during challenging economic conditions. Furthermore, analyze the company's ability to generate free cash flow. Free cash flow represents the funds available after necessary expenses and capital expenditures. It's like having some extra money left after paying your bills and saving for the future. A company with strong free cash flow has the capacity to sustain and potentially grow its dividend payments. Section 5. Diversification and Risk Management. Diversification is crucial for any investment portfolio. By spreading your investments across different sectors and industries, you reduce the risk of exposure to a single company or industry. Let's imagine you're hosting a potluck dinner. Instead of relying on a single dish, you ask each guest to bring a different dish. This way, even if one dish doesn't turn out as expected, you still have plenty of delicious options. Similarly, diversifying your portfolio with dividend stocks from various sectors provides a safety net in case one sector underperforms. Including a few dividend aristocrats in your portfolio can provide stability and reliable income. Dividend aristocrats are companies with a long history of increasing dividends year after year. These companies have demonstrated their ability to navigate economic cycles and sustain dividend payments even during challenging times. Just like an aristocrat with a noble lineage, these companies have proven their resilience and commitment to rewarding shareholders. Bonus point: the power of reinvesting dividends. Reinvesting dividends can be a game changer in wealth accumulation. By using dividends to purchase additional shares, you can benefit from compounding returns and potentially accelerate your portfolio growth over time. The compounding effect allows your investment to grow exponentially as both the initial investment and the reinvested dividends generate further income. Let's illustrate this with an example. Imagine you invest $1,000 in a dividend stock that has an annual dividend yield of 5%. In the first year, you would receive $50 in dividends. If you reinvested those dividends and the stock price remains constant, in the second year, you would receive dividends not only on your initial $1,000 investment, but also on the additional shares purchased with the reinvested dividends. Over time, the compounding effect can significantly enhance your long-term returns and help you achieve your financial goals faster. Conclusion: picking the right dividend stocks is a careful balancing act between income potential, stability, growth prospects, and risk management. By understanding the fundamentals, evaluating a company's financial health, assessing stability and growth potential, and considering dividend sustainability, you can make informed investment decisions. Remember, diversification and the power of reinvesting dividends can amplify your long-term returns. Armed with this knowledge, you are now equipped to embark on your journey towards building a solid dividend stock portfolio that brings you closer to financial independence.
Thanks for watching, and we'll see you in the next one.